What shaped markets today wasn't just the red on the screen, it was a fundamental shift in expectations around how a massive energy shock actually moves through the global economy. We are moving past the initial headline shock and into a phase where investors are pricing in the second and third order effects of a restricted world. After absorbing the initial blow yesterday, the selling accelerated today. The S&P 500 fell nearly 0.9%, and the Nasdaq dropped over 4% as growth-heavy sectors led the downside. Even the DOW, which had been resilient, lost 0.75%. The most telling moves, however, were in the safety assets. Volatility, measured by the VIX, spiked nearly 10% to close above 23, but gold and Bitcoin both weakened, with gold reversing sharply to fall nearly 4%. This suggests that flight to safety is being replaced by a flight to liquidity. Investors aren't just looking for hedges. They are looking for cash. Two main developments forced a reassessment of the macro landscape today. First, the energy crisis in the Middle East is evolving from a price spike into a physical supply chain event. With major production cuts in Iraq and Qatar, the Strait of Hormuz is becoming what some are calling a 21-mile inflation machine. It's no longer about what a barrel costs, it's about whether the fuel is physically available to keep industry moving. Second, we saw a fracture in the Federal Reserve's narrative. While some officials still see a path to rate cuts if inflation slows, others are warning there is no room for complacency given the current energy spike. This divergence in messaging adds a layer of policy uncertainty. At exactly the moment markets were looking for a steady hand, today's rotation shows us that institutional psychology is shifting toward margin preservation. Capital flowed into communication services and financial sectors that typically have better pricing power or can benefit from a higher for longer rate environment. Meanwhile, industrials and materials were abandoned. This is a complete reversal from yesterday's leadership and reflects a growing fear that high energy input costs will aggressively squeeze corporate margins in manufacturing and transportation. Investors are no longer just buying the energy trade. They are seeking companies that can successfully pass rising costs through to the consumer. Beneath the surface, there is a mounting concern regarding the concentration liquidity loop, because a handful of US tech giants like NVIDIA represent such a massive portion of index weight. They have become the ATM for the market. If global institutions face losses in other markets like the current stress we see in Asia, they are forced to sell what has worked best, which is US tech.